Hello, welcome back. So in today's video, I'll be talking about the bear case for all my stocks in my portfolio as a 20-year-old. So in today's video, I'll be covering a few things. I'll be covering the bear cases for all my stocks, as well as some questions left in the comment section below. So let's talk about the bear cases for my stocks first. And this is my entire portfolio. So I have cash around 32%. I have Meta, MSCI, Microsoft, MasterCard, Full Corp, S&P Global, Amazon, ASML, United Health, some Singapore stocks, Moody's, Google, as well as Visa. So I actually asked ChatGPT to come up with all the bear theses for all my different holdings. And this is the first holding that ChatGPT talked about, which is my largest position, my cash position. So cash is around 32%. Currently now, ChatGPT is saying that there's opportunity cost because cash earns around 3 to 5%, while equities compound faster. There's inflation erosion over time as well because inflation will quietly destroy real returns. Your future compounding curve is flatter. And there's fear-driven underdeployment. Holding cash out of fear of valuations or macro can lead to missing out of strong recoveries. So this is way too high unless you're making a near-term allocation. It's a drag on long-term CAGR. So what this report is saying is my cash position is too high. I don't disagree, but this is why it is so high. So what I do in my cash position is my cash position is constantly increasing with flows of income coming in, and that's why it's a lot more outsized. In April, it dropped to around 25% when I was deploying heavily into the markets. But the market is only fair value back then. So the markets right now are at about 28 times earnings. It's historically quite high. Warren Buffett is doing something similar as well. He has around 30% of his assets in cash. And so he clearly thinks that the market is overvalued as well. So of course, in the long term, holding cash will hurt performance. But I think in the near term, we could see opportunities coming in as well, especially with Trump as president. The next stock that I'll be analyzing is Google. So this is what the report said. The report said that there is search risk from AI. So your chatbots could disintermediate search over time. There's ad revenue cyclicality as well, with 80% of revenues coming in from ads, which are macroeconomically sensitive. Cloud is third and losing to AWS and Azure. There's cost bloating as well, with headcount and cost base growing enormously from 2020 to 2022. Slimming down is slow, and there's regulatory headwinds as well. So out of all the risk over here, I think the main one to look out for is the regulatory portion. Basically the antitrust lawsuit that Google is having right now. As for the ad revenue cyclicality, I don't think it is as cyclical as Meta. Meta is a company that is almost 100% concentrated into ads, whereas for Google, it is less concentrated. So I think for Google, they still have the other portions of the business which are growing quite rapidly as well outside of ads. As for cloud, I see it as an oligopoly, with AWS, Azure, and GCP holding their respective market share. GCP has advantages that AWS and Azure doesn't have. They offer competitive pricing, and they're a lot more usable for a beginner as well. And for GCP, they're securing a lot of deals as well, and you will definitely see the profits exploding to the upside in the near future. So let's talk about the regulatory headwind. So this is what I see as the biggest risk for Google today. The biggest risk for Google now is their antitrust lawsuit with the DOJ, which will be settled in August. So in August, there'll be a settlement coming out. Basically what it means is that the judge will tell Google as to what they have to do in order to settle the lawsuit. And the judge actually mouths that there'll be softer remedies in the US search antitrust case. So there's a report in May that said that a federal judge in Washington suggested on Friday he's considering making Google take less aggressive measures to restore competition in online search than the 10-year regime proposed by antitrust enforcers. So instead of your 10-year blockade that your antitrust enforcers are basically suggesting, the judge today is coming out with softer demands as to what they want Google to do. So this could be bullish, no one knows. Let's see what happens in August. If the regulations come out with extremely soft punishments, then the biggest headwind for Google will be out of the water already. As for the risk in terms of AI, so Google is currently leading in AI. So the company that has the best model right now is Google. So besides that, Google has the greatest video generating software, your Veo 3. Google has also started creating its own ecosystem by integrating everything into Google Workspace. And for Google, you can't fault the management because the management is clearly pushing ahead in terms of AI today. Of course, there's innovation risk in the future if they stop innovating and they stop being able to compete in AI. But currently, they're in the lead. So I don't see this as a problem for now. But of course, it could be a problem in the future as well. The next stock that I'll be talking about is ASML. So ASML, based on a report, it says there are China export restriction risks because geopolitics could permanently cap upside if China sales, which makes up more than 20%, are banned or restricted. So management has actually talked about this in the past. What they say is that even if the China sales start to drop, there'll be other parts, other places that will pick up the demand and basically buy over the share that the Chinese have foregone. And then the other risk that this report said is that there is cyclicality to the business because your semiconductor capex is notoriously boom bust. ASML lives at the top of the capex food chain, so that could be cyclical as well. But for that portion, the long-term trend for your capex is up, so I don't think that's too much of a problem in terms of the cyclicality of the business. They said that there is a margin ceiling as well, with cost base rising as R&D and service intensity goes up. But if you're to look at the R&D cost for ASML, the growth rate in terms of your R&D has been slowing down ever since they came out with their EUV machines. And so I don't think this is a problem as well. And then the last one, which I think is a real problem for ASML, is the tech risk. So they say hypothetically, if another country leapfrogs EUV tech, the moat collapses. So what the report says is that it is an exceptional business, but cyclical and politically vulnerable as well. So I think the biggest risk for ASML today is the tech risk, which is Chinese innovation. So the Chinese, they've been basically creating some sort of EUV alternative. They've been actively pursuing that. But currently now, they're lower in terms of yield and higher in terms of cost. So it is being projected that ASML is at least 10 years ahead of competitors. But their perceived EUV moat could collapse overnight if China comes out with something that is competitive to ASML in terms of the yield and as well as the cost. It is almost impossible for you to predict when a country can do that. And that is the problem with ASML. There is disruption risk with tech, and especially so with ASML today. The next set of stocks that I'll be talking about in my portfolio is my Singapore REIT stocks. So this is around 7.3% of my entire portfolio. I hold REIT as well as the Singapore Airlines stock. So what the report says is that there is no growth. These are cash cows, not compounders. Net asset values and distributions have stagnated. So they say it is rate sensitive as well because every 1% increase in interest rate materially affects the DPU. They said CapitaLand Integrated owns a lot of malls and offices. It has structural secular headwinds. And then they also say that developers may offload poor assets to REITs as well. So the verdict is that it is better for retirees than compounders. Low ROIC, don't overweight unless yield matters more than compounding. So for Singapore stocks, a lot of them last year, they were yielding at around 6%. So as a Singaporean, if you're to take into account the US depreciation, the REIT itself, 6% plus maybe 2 to 3% in terms of your capital gains, actually matches the S&P 500. So for REITs, although they are not high quality, I see them as extremely predictable business that will bring in predictable cash flows. And when your interest rates come down as well, this could be a tailwind for all of your REITs. You'll see your DPU start going back up again. Next stock that I'll be talking about is Amazon. So the report said that retail has very low margins, unit economics are often poor, AWS is slowing. They said cost structures are bloated as well because operating margin outside of AWS are near zero or negative. They said the company has low ROIC as well because despite its tech sheen, Amazon often earns less than 10% ROIC on incremental capital. They also said that it is a great business but not a great stock at this valuation unless AWS accelerates again. So to that, this is how I see Amazon. So the Amazon.com website is sort of like a funnel for all the different portions of their business. So Amazon is not just an online store, they have other portions of the business as well, like their third-party seller services, their AWS, advertising subscriptions, and so on and so forth. So the Amazon.com website is a funnel for all these different portions of their business. And Amazon's margins for those other segments can explode over time to the upside if the company starts moving from growth to profitability. So Amazon CEO currently, Andy Jassy, focuses a lot more on profitability as compared to growth, as compared to Jeff Bezos in the past. So Jeff Bezos in the past, what he did was he just wanted to reinvest everything into the business so that the business could continually grow over time. But for Andy Jassy, if you have to look at his annual reports and what he's saying on earnings call, he's a lot more profit driven as compared to growth driven. He's a lot more pragmatic. And so I think this is good news for Amazon shareholders as well. So for Amazon, although retail has a very low margin, I see that portion as a funnel, so it shouldn't be a problem as well. Amazon could easily increase their earnings over time if they want to pull the lever. And so I think Amazon is a quality stock today. Next portion is on S&P Global. So this is what the report says. It says that your credit ratings can be disrupted. Bond rating agencies have regulatory privilege, but if that fades, so does the pricing power. So the bond rating agencies, they are protected by regulators. This is not wrong, but I don't see this as a problem for S&P Global or Moody's because the regulators, they will always need to find someone to blame. And to find someone to blame, you need the credit raters doing their job as well. As for the next bear thesis for this stock, it is your data commoditization. So alternatives like Bloomberg, Refinitiv, etc. can price pressure the market data segment. This is not wrong. There's merger and acquisition risk as well. After IHS Markit, there's integration and cultural risk. That's not wrong. And they also said that there's cyclicality risk as well because the revenue will dip with the debt issuance cycle as well. So the verdict is that the company has minor cyclicality and some disruption risk, but still very high quality as well. So I think out of all the risk over here, the main one, the most concrete one, is the cyclicality portion that they're talking about. Data commoditization doesn't matter so much because for S&P Global, the crown jewel is their rating portion of their business as well as the indices portion. So for S&P Global and Moody's, I see them as tollgate businesses. So even if debt issuance are cyclical, even if the debt issuance go down this year, people will still have to raise credit, they still have to raise debt over time. And as Chris Hone said, the predictability of the recurring revenue doesn't matter so much. As long as the company has pricing power, they can increase prices when the cash flows in are very low, when the recurring revenue into the business is low, and then as soon as they come in, they will earn elevated earnings as well, which is what S&P Global and Moody's does. And for S&P Global and Moody's, they have no risk of regulation because they charge a percentage and a commission instead, not a fixed fee. So if you were to compare what S&P Global and Moody's does as compared to FICO, FICO charges a fixed concrete fee, so it's very trackable for your regulators. They can see the fee and the drastic change, and they will start commenting on it. But for S&P Global and Moody's, they charge a percentage, and for S&P Global and Moody's, that is why they are unaffected by regulation, because it is seen as not so obvious as compared to FICO's price increases. So for S&P Global and Moody's, they are high quality businesses, although they're a bit cyclical, but they are long-term holds over time. The next stock that I'll be talking about is Meta. So the report over here says that there's TikTok risk, there's ad model dependency, there's the metaverse money pit, and there's reputation and regulation risk as well. So for Meta, it is one of my weaker stocks in my portfolio. It is one that has high risk because the company is almost 100% in your ads portion. And the report is not wrong about the metaverse money pit as well. So Mark Zuckerberg, he likes reinvesting into the business a lot. He always likes to pump money into the business. Whether or not it will be able to give returns to the shareholder over time is something that's questionable. And Zuckerberg is doing something similar now as well. So this is a report that recently just came out. It says that Meta seeks $29 billion from private credit giants to fund AI data centers. So they're saying that they're hoping to raise $3 billion of equity and raise another $26 billion of debt. So this is the problem with holding Meta. Meta is a founder-led business, so Mark Zuckerberg will always try and push for growth. His capital allocation at times is not super shareholder-friendly, and that is the problem with Meta itself. That's the risk I see with the company. Mark Zuckerberg is not the most shareholder-friendly in terms of his capital allocation. You're seeing a lot of dilution as well as misuse of capital over here, and that's why I think Meta is one of my weaker stocks in my portfolio today. Next portion, I'll be talking about United Health. So this is what the report said about United Health. They said that Medicare Advantage margins are compressing. There's regulatory risk as well with US elections affecting drug pricing, insurance reform, broker commissions under scrutiny. There's complexity as well because the business is almost impossible for you to 100% understand. There's negative political tailwinds as well, which can get punished in election cycles or populist regimes. So the verdict is that the company is a good defensive, but watch for 2025 Medicare Advantage margin pressures. Medicare Advantage margins have been declining over the past year because their old CEO, which is Andrew Whitty, he took in a lot of new members into the system itself. He took in a lot of members into United Health because he wanted to increase the top line growth. But when you do that, the problem is that there will be a lot of high-risk patients under your system. That will increase the cost over time as well, affecting the MLR of the business itself, and that is why you're seeing the Medicare Advantage margins dropping as well. And for United Health, they're doing what they can to exit the Medicare market. They're reducing the broker commissions, and in the short term, this could be a headwind for the business as well, especially for the top line as well as the bottom line growth. So for United Health, it is a company that is facing regulations as well. So you have the Medicare Advantage fraud case that will be resolved soon. So there will be the lawsuit settlement in the next month, as well as the earnings coming up on the July 29th. So this could be a very eventful month for United Health. We have to see how it plays out, but I expect the management to issue lowered guidance, which could hurt the stock as well. Next stock is Microsoft. So the report said that Microsoft's valuation is full right now. AI monetization is unclear. Azure margins is lower than AWS. Windows and Office are mature as well. As for the moat of the business, I think Microsoft is fully bulletproof. It is one of the most bulletproof stocks out there. In fact, it is one of the higher quality stocks in your tech sector. So for Microsoft, the only problem that I see with it is just the valuation. So in summary, the highest bear case is my cash position, my high cash position, as well as Singapore REITs. Other than that, I feel that the companies in here are quite high quality. Last portion, I'll be talking about some questions left in the comment section. So the first one is, says, can you speak to the debt levels of MSCI? It's the only thing keeping me from pulling the trigger. So for MSCI, they actually have quite a high debt level in terms of debt to EBITDA. So the debt to EBITDA, I believe, is around 3 or 4 times. But for MSCI, what they did was, when the interest rate were low, they actually raised a lot of debt to buy back a lot of shares. So that proved to be a very good decision by management itself, And for MSCI, it is a recurring revenue business, so I wouldn't be so concerned with the debt levels because of the predictability of the cash flows. And for MSCI, Henry Fernandez actually came out saying that he won't be increasing the leverage of the business, so the debt level shouldn't be a problem for MSCI in the long term. As long as rates come down, and as long as the company can continue bringing in predictable cash flows, I don't think it is a problem for the business itself. In fact, it was a good decision by management to increase debt at 0% to buy back a lot of their shares. Next one, it says, how come Adobe isn't here? Amazing fundamentals with Google level valuation. So for Adobe, if I were to look at the revenue itself, Adobe's revenue growth is incredible. Adobe's fundamentals are incredible. Everything about the stock is incredible, except for one thing, which is just the story. So for Adobe, the problem with the stock itself is it faces a lot of headwinds in terms of your AI, and the company is not actively deploying AI into their suite of products, which is the problem with the business. So for Adobe, they're lagging behind in terms of AI. Google coming up with a View 3 is a lot more competitive as compared to Adobe. And for Adobe, although the fundamentals are amazing, although the valuation is amazing, the company is facing disruption risk, innovation risk, as well as structural risk. So I wouldn't be actively looking at Adobe. It is a company that is cheap for a reason. It is Google at another level in terms of risk. So for me, Adobe is an avoid. I hope you guys have found this one useful and invest safe.